Good afternoon, everyone. How are you? I'm Lori Lamenti-Gardi. I'm with Silicon Valley Bank, and it's really a pleasure to be here today. For those of you that are not here to learn about angel investing, now would be the time to leave. This panel is on angel investing. Those of you that are excited to learn about angel investing and what it takes as future entrepreneurs to get funded by angel investors, welcome. So a little bit about me. At SVB, I manage the bank's relationships with angels, universities, and incubators. So I've immersed myself in the angel world for the past 12 to 18 months, and it's really, really exciting to be here to talk with our panel here. We have a really unique and diverse mix here. We've got two very, very successful entrepreneurs that have raised significant amounts of capital, both from angels as well as from institutional investors. We have a mix as far as one is a serial entrepreneur and the other is a first-time entrepreneur, so you're going to hear a unique perspective in terms of their experiences in raising capital and what it's been like. We also have the great pleasure of having two really wonderful angel investors who have been at this for quite a long time. So we have Bob Zip and Aydin Sunket, who both have a fund that they invest through and who have seen a lot of deals over the years. So I'm actually going to let our panelists, rather than read their bios, I'm going to let our panelists introduce themselves and maybe talk for Bob and Aydin, talk a little bit about how you got into angel investing, and for Anu and Todd, maybe talk a little bit about your companies and your fundraising process. So we'll start with you, Bob.
Okay. My name is Bob Zip. I'm founder and managing general partner of a fund called Amicus Capital in San Francisco. I founded Amicus in 1998. Initially, it was a $25 million fund. It's structured as an evergreen, so I've continued to invest out of proceeds, and I've invested close to $40 million to date. I focus on very early stage companies, typically two entrepreneurs and a business plan is sort of what I say. Pre-product, pre-revenue, immediately post-conception usually. I got into investing as a lawyer. For the 10 years before I started Amicus, I was a lawyer with Brobeck, Flager & Harrison and with Venture Law Group here in the Silicon Valley representing tech companies. And in that process came to know many angel investors and institutional VCs, was interested in being on the other side of the table and took the opportunity when it arose.
Great, thank you. Anu?
Sure. My name is Anu Shukla. I'm a serial entrepreneur. I founded 3 companies, and I've used both angel funding and VC funding. Actually, all 3 companies were VC-backed and also had some angel money to get us off the ground. I have, on occasion, angel invested myself. I think we were discussing this panel before, and I thought it was particularly interesting that the times have kind of changed in terms of how you can get to revenue a lot faster, and it changes the flavor of how anybody should view funding, angel, VC, or otherwise.
My name is Aydin Sunket. I've been making angel investments for the last 4 years through my entity Felicis Ventures. I was an early Googler. I was there from 99 to 05. I started as the first product manager and was responsible for the international expansion. And when I left, I kind of took advantage of this wave of costs going dramatically down to start a company, mostly in the consumer internet and mobile sector. In the 4 years, I made over 50 investments and have 11 exits to date. And even though I invest in a smaller financial scale compared to Bob, what I try to do is really help the entrepreneurs with getting the best investors, helping them form syndicates, and then really helping them at major turning points in their companies. And I also happen to know Todd as a friend and also an investor in his company, so it's a very interesting perspective today to be on the panel.
Great. My name is Todd Sacerdoti. I actually attended Stanford Business School, graduated in 2003. And in August of 2006, I raised money for a company called BrightRoll, which I co-founded with an engineer who I knew from my prior company. Since that point, we've raised 3 rounds, $1 million angel round, and then 2 subsequent institutional rounds. So I've sort of learned a lot about the fundraising process, both as a first-time entrepreneur and as going through both angel and institutional fundraising processes. So look forward to the dialogue.
Great. What I hope to do in the next hour and 15 minutes or so is really help demystify the fundraising process, give you some insights on what angels look for when they're looking for deals, and also just some strategies around how you might approach fundraising from angels, and some of the differences and nuances between raising angel funding and institutional funding. So I'm going to save plenty of time for Q&A, but we're going to start a kind of a general dialogue right now. And, if you have questions, feel free to chime in as we go along. So Todd, to kick it over to you first. Sure. So I read, I read somewhere that when you raised your first round of funding, that you had 9 angel investors lined up for that. So can you maybe talk a little bit about how you got to 9 and what it was like corralling 9 angels? I mean, we often hear that herding angels is like herding cats, and so I'd imagine that was kind of an overwhelming process.
Yeah, it was challenging. I think that, at that time, we were, as a company, myself and my co-founder, we really made the decision that we wanted to have angel investors and not institutional investors. A lot of that was driven by, we were extremely early stage. We still wanted to have a lot of flexibility around making decisions. We didn't want to sort of have a huge overhang of capital in the company. And we were still just iterating really quickly. And from our diligence with other companies, we had heard that was the right path, and so we pursued it. So we met in the process probably about 50 investors through that process. Most of the leads that we talked to during the process came from, a very small set of personal relationships, and then asking, every investor we talked to give us 2 or 3 other names of people that, they thought highly of. And it really is very much an iterative process through that group. But we talked about this on the call earlier, but the most important thing for us during that process was to find somebody who's willing to lead the round. And the person who's willing to lead the round really ended up corralling the group and sort of driving the group, driving the process, driving the timing. And so once we found that, it did make the process a lot easier. But still, it was definitely herding cats for the beginning process and really just trying to get interest.
Mm-hmm. And Anu, how about you? Maybe talk a little bit, so for 3 companies you've been out there, and I understand that you've intentionally raised from angels. So maybe you can talk a little bit about that.
Yes, to me it was, I always, when I started these companies, I always thought they were targets for venture money. The first company I did was a company called Rubrik, for which I raised about $13.6 million from venture capitalists. And initially, our angels were my co-founders, relatives, and my relatives and myself. So what we wanted to do was really take, $250,000 or $500,000 and prove our concept so we could get a higher valuation in Series A. And that, I thought, was the sum total of the reason to raise angel money, is that we need some seed money, whether it's coming from me or a group of people, interested people. We didn't really think about the value they could add. It was just, these people are going to put money in without any questions, without even a meeting. They're just going to send a check, okay? And they're never going to talk to us again. They're never going to talk to us again. And what we're going to do with this money is we're going to, go talk to prospective customers, maybe build a prototype, and then spend the time to pay for the office, and then go talk to venture capitalists. So my goal was always to get to a VC, because in the first company I was building an enterprise software company. It was rumored that you needed, $50 million to really build an enterprise software company. We managed to have an exit after raising $13.6 million for about $366 million. So everybody was happy, including our angels, who made a ton of money. And we always did this as a convertible because it was a small amount, so they got in at the Series A valuation with a little warrants and stuff. For the second company, same. I was building an enterprise software company which evolved into a SaaS company. Again, it takes a lot of money to build those. And so I was in a position to put more money as an angel myself, but also, again, friends and family, co-founders, relatives, that sort of thing. Generally, the first group that had invested in the first company came along. And then I did the third company, which is called OfferPal Media. And over here, I also took a little bit of angel, but I found that this is, Web 2.0. I could actually get the product built pretty quickly without too much angel money even. And again, my target was just to get to that, VC round at the highest valuation possible. So I raised, $4.6 million in my Series A after putting in, $250,000 of angel from various same friends and family. And never thinking that the angel would add any value except send the check and don't bother me. And it turns out that OfferPal, became profitable in 3 months and started to hit triple-digit revenue. We never touched that funding. And so when I look back at it, I said, we shouldn't have raised any money at all. Or we should have really gone to some angels who could add value and maybe raised $1 million to make us feel good and attract talent. And this wasn't a VC deal at all. Not if you can hit profitability in 3 months. Maybe you go for venture then, and then you get a much higher valuation. So I'm really rethinking my whole, just take some non-obtrusive angels and then go straight for VC strategy. I'm completely rethinking it for venture number 4.
Good. It's good to be thinking of venture number 4 as well. And Bob and I know that you're both pretty hands-on, so maybe we can talk a little bit about the difference between a value-added investor and a non-value-added investor. So, in your opinion, how involved are you? You're pretty involved with your companies. What are some of the things that you're doing for your companies as you invest in them?
So let me take a first shot at it because my answer is going to be non-traditional. Let me requalify. I am not hands-on. I am high value add, or at least that's my goal. And let me also clarify what that means. So a lot of people ask me as an angel, well, how much time do you spend with your companies? And as you well know, this is not about quantity, it's about quality. I feel that there are 4 or 5 major milestones in the company's history. And to the extent that I can help in those and not really mix in or cause any trouble with the founder and always be there when the founder needs me, that's the highest value I can add. The first milestone is fundraising. So the most important thing I can do for the founder is, like Todd said, getting that lead and getting the right investor mix is really important. And a lot of time, because the founders are also running the company and growing the company, they don't have time to really understand the investor universe and figure out what is the best match for them. So that's one area I can help. The second one is hiring and critical decisions in the company. And when I started, I've seen how some of the things could be greatly done at Google, and I think that was a very valuable experience. I also went to business school, but I feel a lot of the significant things I learned at Google, how they did things out of the box. In terms of other value add or important milestones in a company's history, then there are like important hiring decisions or sales decisions. So that's where I try to come in, make connections. And the very last one is when actually a liquidity event happens. I don't think we see as many IPOs today, but the acquisitions are pretty common. And that's a very, very tough process. And being able to get exposure for my companies, increasing their potential likelihood, I can spend 1 hour on a phone call, actually make an exit happen or double the company's value. It's worth more than 1,000 hours I can spend with the founder. And also I think there is value in not calling the founder every week, what have you done for me lately? Kind of leave the guy or woman to in peace, like they can run their company, but like be there for the important things. So I think this is one of the important things. There's always this talk of like value add VC, value add angel. I am very pragmatic about that. I mean, it's all about the real value you can create for the founder. It could be one call, it could be a connection, but being able to follow through that and execute that is very important.
So would you ever invest in a company that you felt you couldn't add value or that really was looking for a passive investor?
I would not, because the other thing I was going to say, I mean, I don't want to get too far carried away from the conversation, but you have to understand that venture capital is not about risk business, it's about risk reduction business. So we're looking for great opportunities, huge traction, huge growth, and how we can reduce that risk so we can make that outcome as likely as possible. So if I can add any value, then I'm dumb money, and there's a lot of capital out there. So there is no sense for me to get involved, because basically the very first thing I'm trying to do is, can I help this company in any way to reduce the risk and increase the value of the investment and create a win-win situation?
How about you, Bob?
I agree totally. In my experience, and I've invested in 50 companies too, although over a much longer time horizon, there's an inverse relationship between the level of investor involvement and likelihood of success. The best companies have very strong entrepreneurs with their own minds, who are very clear about where the company is going, and happy investors who show up at board meetings and enjoy the results. High fives all around. One of the first companies that I invested in was subsequently invested in by a venture investor who is no longer in the business, and you'll understand why when I tell you this anecdote. For the first 18 months of this person's management of the investment, he had the CEO of the company call him every day at 4 p.m. The CEO would call, explain what he had done that day, and explain what he planned to do the next day. And amazingly, to the CEO's credit, to the founder CEO's credit, the company was a success, but he hated every minute of it. And that guy, although he perceived himself to be highly involved and highly value add, he was actually a value, limiter, value detractor. So, I agree completely with Aydin. You want to find investors who have experience, who are there to provide helpful advice and counsel when you need it, and who are not stepping on your toes when you don't need it.
So shifting gears a little bit, I'd like to talk a little bit about the process and what it takes to actually, as investors, what it takes for you to invest, and as entrepreneurs, what it takes to get to a term sheet. So in the past 12 months, Aydin and Bob, how many deals have you invested in, and how many deals have you seen relative to that? So what, give the folks here a sense of what your deal flow is actually like.
So I invested over a dozen deals in 2009, and that was a very tough year. And I'm probably right now, it's hard to remember exactly how many deals that I've seen, but incoming leads is probably around 10 to 12 a day. And I have to be honest with you, it's impossible to keep track of all of this, so it's really exciting. And I have to pick and choose which are the best potential options so I can really help them. In terms of investment process, again, I think, the most important thing here is every 6 to 12 months, like Todd's, let's just take a deal. So when I spoke to Todd, he had some critical elements of what I'm looking for. So number one, right at that time, video was exploding, and I'm like, okay, so I missed that wave. It's too late to invest in video because it's already exploding. What's the next big thing? Video monetization. So that was one of the 5 areas I was looking into, and that's exactly what Todd was targeting. The second thing is he was referred to me by somebody that I really trust, who's an entrepreneur himself and is a very good friend. So I could, I already knew Todd, but then I had somebody that could really vouch for him, so that's another really important thing. And then finally, the thing that really what it boils down to is, you're looking basically, when you're meeting the entrepreneurs and investor, you want to have confidence that whatever they're saying, they're going to deliver. They're in an exciting business that's going to grow fast. They have kind of figured out what they need to do. They have a good plan, and they're going to create what I call an unfair advantage. And they have the best chance to do so. So when I looked at Todd's track record, I'm like, great, like he's already worked at a great company, and everything that he told me, he had a strong grasp of the business, and more importantly, he knew what his differentiation was gonna be. It wasn't just a PowerPoint of, everybody's like, this is $1 billion market, we're gonna go and here's the competitive matrix, all of that. What I really want to hear is how you're gonna excel and make a difference with your idea, and how likely are you to do that. And just to kind of extend on the previous point, in the beginning, it's not like you have all the chips you want, right? It's you and your co-founder, maybe 1 or 2 other people. You have to look at your investors and advisors as your extended team. Whatever is the strengths you don't have, whatever is the domain expertise you don't have, that's basically an important function of your investors and advisors. Being able to get that mix right is one of the most important things. You have the best team, even if you don't have the best idea, you have much higher chances to win.
My funnel's a little bit smaller than Aydin's. I probably looked actively at 200 deals last year, invested in 5. And by looked actively, I mean at least had a meeting face to face and thought about it. I agree with Aydin that it's it's a challenge to be able to provide good feedback to every entrepreneur who wants to meet with you, and that's probably my biggest issue and my biggest regret. I wish I could provide more to all the entrepreneurs out there who are looking for funding and looking for feedback.
So how does somebody grab your attention, though? Is it making that personal connection to to you? Is there, if I'm an entrepreneur and I want to get your attention?
It's coming in through a trusted source.
Is it that?
It is the way to optimize success. Come in through a lawyer, who is well connected in the community, an entrepreneur who's well known in the community, or someone in my network, another investor. Those are typically the three best ways.
I agree with Bob, and I'm going to try to expand, and hopefully I can put this into a framework for you. So all you're trying to do when you're trying to meet investors is create a positive bias. So let me explain what I say. Most of the entrepreneurs I'm meeting, all you have to do is 10% more homework. Do your homework in terms of who you're meeting, what they invested in the past, have they said anything in the press in terms of areas that they're looking at, and anything in their background indicates that they're going to be interested in your idea. So people just kind of like launch into their presentation, they're excited about their company, but they don't even think, first of all, they didn't even read the body language. Does this person even care about the idea or even meeting me? Is there a good chemistry? I mean, you have all the sources now, Google, LinkedIn, Facebook. I mean, you can get so much information in a very short time about the person. Find out if they have a positive bias. If they're a biker, you're a biker, that's a positive bias. If they worked in healthcare, you're trying to do a healthcare startup, that's a positive bias. If they invested in 5 video-related companies and they are knowledgeable about advertising and you're trying to do advertising, that's a positive bias. What I'm trying to say is if you try to talk to an investor that looks great on paper but has no connection to your idea, you're not going to get the connection and you're going to be frustrated because you're going to keep having meetings and you're like, why is this person not relate to my idea? It's because they don't care, right? Like, how do you make them care about the idea? How do you make them care about talking to you? And that's one of the most important things you need to get across.
So when somebody says get some more traction, what if an entrepreneur hears that? Is that something that they should hear? Should they interpret that as really get some more traction, or is that a polite brush off? Because I think that's an important, entrepreneurs hear that quite frequently.
Well, they also hear it's intriguing.
Or find a lead and I'll jump in.
Yeah, I think get some more traction is probably 99% of the time. That's a polite way of saying no, honestly. Or a polite way of just kicking the can down the road and trying to stay connected with the entrepreneur in case something good happens in the future.
And intriguing means no, unless Kleiner drops you a term sheet, in which case
Call me back.
Call me back. Yeah.
I mean, I'd add a little to that. I think that as a first-time entrepreneur, a little bit of traction was extremely important in my process. So, if I were raising angel money today, I think off of, reputation relationships, I'd have a lot more success than I did at the time that I started. And so when I started the company, I started it while I was working at another startup. It was nights and weekends, and we worked on it for 6 months till we had a working prototype. We had a couple customers, and then I left that company and I spent 3 months building the product before I went to raise angel money, because I felt that at that time, with my reputation, I wasn't going to be able to raise angel money without traction. And so maybe the feedback would have been get some traction. Maybe that was good feedback. So I think that I think the sort of the earlier you are in your career, and if it's your first time entrepreneur, traction of any kind is a great indicator and something that you should focus on, not just an idea and a deck. So.
But there's traction, and then I just filed the S1 for the IPO. Okay, it's somewhere, you have to qualify what traction really is. Right?
And how many angels did you approach before you got funding in your first company?
I actually didn't approach any of them. They approached me.
They did.
Because remember, they were part of a close-knit group.
Okay.
So it's basically people that were involved with the company, even like a founding engineer, would say, well, my dad wants to put in $100K kind of thing. So we're like, okay, maybe we'll take it.
So how long is the process? How long does it take for you guys to come to a decision? Is it, in the first, you had me at hello?
It can take anywhere from 48 hours to multiple weeks. Partly it's so. Again, I think everything kind of boils down to the different risk involved with making the startup successful. So there is funding risk. So let's say that you already have a lead and you have some of the rounds spoken for, that decreases. Then you have team risk. So how comprehensive is the team? Is it just one founder? Is it 2 founders with 2 really good people with some great advisors attached, right? So it kind of comes down to the traction problem. If somebody's asking for traction, basically the translation of all these different things, intriguing, traction, whatever, are 2 things. Number 1, there are not enough data points for me to have conviction, and number 2, It could also be, you know what, I'm not really a capable person to be convicted at early stage, so I'm going to make the investment as late as possible to reduce all the risk. And that's, I think, the black art of being a good investor. How early can you make that decision and can still be right or have good chances of being right? But, basically what I'm trying to tell you, there are some times when, the deal is so hot that supply and demand, it's an incredible founder, great idea, no-brainer, and you just, as an investor, you want to be involved with that kind of an entrepreneur and deal, assuming that there's a good match. And sometimes it's a tough process. I mean, there have been times when I'm the first investor that spoke to a founder, and we literally called every single investor, got in the round together, and it took longer. But, the outcome was still the same. It's a positive outcome, getting it. And again, it's very important when you're actually going through the process yourself. I mean, Todd said he spoke to 50 investors and got to 9. So it all comes down to like checking off every risk factor and really asking yourself, have you really covered all the important risk? And in the investor's mind, have you convinced them that you have the best chance of winning against the odds? And do you have the right unfair advantages to beat those odds?
Very good. So what about valuation? I mean, how do you value, Bob, I think about you, it's a concept, it's a PowerPoint, you've got a team here that's ready to go. Is it you throw a dart or?
Generally, the deals are valued in two ways. They're either valued as a function of the venture round, a subsequent venture round, and so structured as a convertible note with some warrants or a discount or something, so that the whole valuation question is sort of moved down to the next fundamental event. Or if the deal is priced, generally it's priced within a valuation range that assumes that there'll be a reasonable markup on a subsequent venture investment, and that sort of target moves up and down, depending on the market and the time and the environment and so forth, but is generally within a range.
So I think the simplest way to look at it, this is the question that gets most asked, how do you value a company? So it's very simple, it's supply and demand. In every other place in the world, for any price, it's how much supply you have and how much demand you have. If you have a lot of supply, you have no demand, the price is going to be low. So the most important thing for you is not to take that personally. Your job is to increase the demand, right? So when you're looking at the valuations, I mean, it's ridiculous, but for all the sophistication we have at business school and science we learn, really you don't really have any data points to go by. So everything else being equal, somebody who has more conviction and positive bias towards your idea is probably going to be more receptive to paying a higher price to be involved in your company. But again, the most important function is demand, and then basically for the investors to have enough of a stake to compensate for the early risk they're taking. I mean, it's a fine balance, right? As an entrepreneur, you don't want to give up too much of your company, but you also have to be smart in the sense that if you get the right people and the company gets really big, you might be giving a little more of your company, but then the overall pie is bigger. Having an 80% of a company that is not valued at anything is not a good thing either. So have a reasonable balance, and I think it's really important to incentivize and motivate your investors, for the right investors, right? So don't always get stuck at this, I need to have the perfect terms. No, I think it is a balance of terms, who the investors are and how much value you feel they're going to bring on the table, and are they going to be able to plug in any of the holes that you have in your team or in your company.
From the entrepreneur's perspective, do you guys have a different view? Or?
Yeah, I would just add that during my process, I was really focused on basically two things. One was completing it successfully, i.e. raising the money. And the second thing was having the process be as short as possible because, we were a small team with limited resources and we really just didn't want to be distracted. And so when I talked to lots of different sort of entrepreneurs that had been through the process, it seemed to me that as a first-time entrepreneur, the fastest route was to pick a valuation that was within the bounds of being fair and doing a closed round, not doing a convertible, because it was just easier for people to understand. They can make the decision faster, and they didn't have to worry about the terms around the convertible. And so I basically just picked a valuation that was comparable to other deals that had gotten done, and said it's a Series A, and that proved to be successful. Of course, there's some maybe we gave up some margin. We could have made more by having it converted at the later round, but the reality was I got the money and it was fast, and that was the most important to us.
I'm in the same boat there because I just talked to comparable companies and looked at what their Series A was done at, and for the angel, how much discount was I was willing to do, and worked backwards from there. But I have to point out that one of the things that we didn't consider in the angel round, we considered the fact that we could get this money and get going, and there was no overhead associated with raising the money, which was, probably very convenient. But I think we missed an opportunity at all three companies that I did, although all of them are successful. That was, getting the right angel involved could have, helped us in many, many other ways. And we always thought once we get VC funding, we'll go get an advisory board and we'll put them in place and we'll pay them, give them stock to help us. But I think that we never gave enough importance to getting the right angel involved early in the company. And that's something, if I had to do it over, I would rethink that.
Company number 4.
Company number 4 is on its way already.
Shaping up to a nice company so far. So, one thing I'd love to talk about, since we're on the subject, is how does an entrepreneur come up with the right amount to raise in the first round? Does it really come down to supply and demand, what angels are willing to invest in it? Or, is there kind of a set rule? And
That's a really good question, because I have to say that everything that I'm saying on this panel are limited to consumer internet and mobile companies. So it's an important distinction, right? And the reason for that is A, that's where I have the experience, and B, that's where I've seen is the highest chances of growing a company fast. That doesn't mean that you can have a very successful company in CPG or in semiconductor or in any other areas. There are a lot more friction points. Getting things right and getting through those hurdles is tougher and it's going to require more capital. So that's where I focus. But I think the lessons are still applicable to other areas as well. And then when I talked about supply and demand, I actually talked about the price. In terms of how much capital to raise, is again, I think it's a surfing analogy, right? So you're right at the edge of that wave. You don't want to raise too much capital where you get too lax. You also don't want to raise too little capital that you run out of money or you have to go raise money a little bit too soon. The whole point here is that not getting too carried away from the real value of the company. Of course, as an entrepreneur and CEO, you think very highly of yourself and the company, and you should have a healthy dose of an ego, but you should also be realistic in terms of, not that valuation to get carried away too much, because you're going to have to build the company to that level. So everything else being equal, raising just enough money to get you to that next step. And as Anu said, and I think Todd implied, the important traction points where it's obvious the company is growing fast, it's obvious you're checking all the check marks and you have a leadership position that's going to get you a higher valuation. And don't raise capital unless you need to, right? I mean, I heard an example that Microsoft raised a total of $1 million, eBay raised $5 million, Google raised $25 million, and that was probably for good reason. But a lot of these companies probably raised a lot less than you expected for the size of the companies they are now. So just remember that, and I know this is easier said than done, especially if you're in semiconductor, CPG, or life sciences. But again, the goal is, like, if you're in life sciences, try to find somebody who knows the area, who can help you with the FDA process, or you have a brilliant idea and somebody that can help you avoid costly mistakes and avoid getting into some of those friction points.
When we sat down to think of how much money we would need, I think it was all about having the money to reach a milestone, the next milestone. So whether it was shipping the product or first revenue. I think a lot of people, we talked a little bit about traction, that, when you go to VCs or angels and say, well, you need a little bit more traction before I can really believe in it, and what that really means. I still have to say that the first round, the Series A that you raise, is the easiest round, okay? The bar really goes up significantly from there, because you have to explain what you did with that $4 million and where you're at right now. And now there are other people there that need a certain type of exit, and you're trying to raise the value. So in some ways, it's the easiest round, but it's also important to take, as Aiden said, the right amount of money to get you to that next important milestone, because the bar is higher when you get there.
So it's called raising on hope versus raising on reality, right?
Yes.
When you're raising your Series C, you're now being compared because you have real revenue, so you're going to be, judged on almost public market multiples or some stricter financial criteria, versus early on, you're kind of mostly raising money on hope in terms of who you are, what a great idea you have, and how convicted people are that you're going to be able to execute to grow this company.
The practical response that I give to entrepreneurs to that question is, think about the PowerPoint deck that you're going to present to the first institutional VC that you meet, and what would you like to have in there? What would you like to have in there in terms of, progress that you've made with the angel capital that you've raised? Plan to how long will it take you to achieve those milestones? Add 3 to 6 months, add 3 months worth of run rate, and that should be the target raise amount. Usually that works out to somewhere between 12 and 18 months in my experience.
And Todd, I think you mentioned something earlier about finding entrepreneurs that have raised angel funds and the importance of that in terms of shadowing them. How maybe you could talk a little bit about that and how that helped you with your round.
Yeah. So one of the, when I look back at my angel fundraising process, the sort of key person and a key sort of element in that process was a friend of mine who had literally just went through the angel investing, sort of angel fundraising process himself. And as GSB students or connected to Stanford, there's lots of people that are alumni that have went through this same process, probably in a similar industry in the last, sort of 12 to 24 months. And so to have a shorthand for so many of the decisions made my life so much easier. So I said, how much do I need to raise? I did all my calculations trying to figure it out, and I had a benchmark. Well, he raised $1 million, and all things being equal, looked like I was about the same number, so that seems about right. So what was his valuation? He picked a valuation. I was very close to his valuation, and who I went to talk to were similar to who he went to talk to. So in a lot of ways, having a shorthand for something that had zero experience in made the process, enormously more efficient for me. And that's been true at every stage. So, I've now raised 2 rounds, and I always try to find people who, because the market is different. Raising a Series C today is very different than a year ago or 2 years ago. So you try to find people who've just done it, and you try to learn as many shorthand lessons as possible.
So maybe shifting gears again, I want to talk about angels themselves and how maybe all angels are not created equal. So we talked about value-added angels and non-value-added angels. Is there a difference between professional angels, so people that do this as a living, versus casual angels? And maybe we can talk a little bit about some of the VCs that actually act like angels and how that's impacting how companies are getting funded. So.
Maybe I'll give you the entrepreneur's viewpoint. And I just think that now more than ever, the whole angel investing model, especially for consumer internet, makes a lot of sense. And I didn't have this feeling in earlier companies that I did, but again, if I haven't repeated it enough times, I absolutely do have that feeling right now, that it's a very viable model and one should look at it. And I think VCs are sensing that as well, so they've either set aside funds or they're willing to do smaller investments or incubate you or do entrepreneur in residence programs, because I think the whole venture economics have changed quite a bit in the last few years with the change in exits and the type of exits you can get. I think other than some funds, they have gotten smaller and more focused. And so you would expect to see those kind of activities. And I think the professional angel is a lot more attractive than the casual angel, because the casual angel is really about money, and the professional angel is about value add, and with the appropriate background and the appropriate contacts. So even though I've taken money from casual angels before, at this point I would seriously look at professional angels if I was doing a company.
Yeah, I think, again, just to kind of give you a practical answer, majority of the angels out there, I've done a keynote on this. I think there are 100,000 angel investors in the US. That's a pretty broad definition, right? Family and friends are included in that. So those are people that have high conviction and would probably give you money at any term. And then there are people that kind of make 3-4 investments a year. It's kind of a cool thing to do. Maybe they're like great lawyers and doctors or other professional services, had some money. They kind of enjoy, the thrill of getting involved in a company. I think there are 2 key things you're looking for here. Number 1, active, right? You need to make sure that the person is active, is investing right now, not in the past, right now. What is their track record? Are they actively investing? Number 2, everything else being equal, the more investments or a more comprehensive portfolio an angel has, more pattern recognition, hence better conviction, easier conviction, right? And it also gives you more data points of how they made those decisions. You can probably see more trends in the investment decisions they made. If somebody's only made two investment decisions over a course of 5 years, well, draw your own conclusion versus somebody that kind of has a comprehensive portfolio and is very active. Again, those are all about probabilities of connecting with the angel, and then also just be very clear. I mean, some angels invest in smaller amounts, some angels in bigger amounts. I think the other distinction here is, some people have huge wealth and they can invest in huge amounts. Some of the angels have professional funds, so they can invest in comparable amounts. And some of the angels might invest in smaller amounts yet add value in different ways. And just be clear who's who and who do you need. And you probably might need some combination of those in your syndicate. And make sure that you optimize for that, but also be very clear. Don't go after 100 people that invested $5K each. Don't also just go after one person that's going to invest $1 million, because that's probably going to move a little bit more difficult. So have a balance somewhere in the middle.
I'll speak to the issue of venture funds moving downstream into the angel market, because that's something I have a bit of a bias about. Venture funds typically have large pools of capital and relatively few investing partners. And for them to be able to invest, to provide the kind of return that their limited partners are expecting, they need to put a lot of money to work, and they need to have big successes. And that structure does not translate well into systematic angel investing. To me, it may seem appealing to have A-level brand name venture firm investing in your seed round alongside value-added angels and value-added seed funds, but it's problematic. It can be extremely helpful. It can be a problem, particularly when you're trying to raise your next round, because you've sort of got the upside is you've got brand A-level, institutional VC firm there, standing, presumably ready to write a check. They know they're inside the tent. They know everything that's going on. If for any reason they choose not to invest, you might as well forget about it. It's exceptionally hard then to raise capital, to explain to another investor why, Joe here, who's been backing you and following you for 18 months, has decided not to follow you. So there are enough sources of high-quality, value-added angel money today that I would be reticent to access institutional venture VC at the seed round.
Hey, I was going to add, just because I took some institutional angel, I sort of segment the angel investor into 4 categories, and this is what we did at the time we were raising. The first is sort of institutional angels, and these are, I wouldn't call the big venture firms that have angel arms. I would call these are the venture firms that basically focus on, Series A or very early investing, which we ended up taking half of our Series A from. The second would be professional angels. The third I call operational angels. These would be CEOs, people who know how to build businesses from the early stage, or people who have operational excellence in your category. They don't necessarily have to be people that were at the senior level. And the fourth is just people with money. And when we were raising, we took really a hybrid of, the people with money, the operational angels, the professional angels, and we had this institutional venture investor. But I feel extremely strongly that you want your lead, if possible, to be a professional angel or to be an institutional venture firm that acts like an angel, because when we went to raise later rounds, they were hugely important in representing the entire angel group as a cohesive unit and adding a lot of value to that fundraising process. And I got huge advantage from operational angels, people that were CEOs of companies or who had built businesses in our category. If I were to do it all over again today, I would not take any money from people who just had money. But at the time, we didn't have that luxury. But I think that for the very early stage VCs, there can be very value add, but not the traditional firms that just put small amounts in to dabble. That was our experience.
So, it's interesting because we always think of investors do due diligence on the entrepreneurs and the companies. What kind of due diligence should entrepreneurs be doing on you as investors, and what have you both have done in terms of the due diligence on your investors?
Sure. So initially, when I first started out in my first company, I was very keen to involve good venture capitalists in my company and in my idea and to take money from them. And so I thought, with their help, VC-backed firms, have a higher exit rate or success rate. That was my impression. And, I didn't do too much due diligence on them because I was just keen to get them involved. So I didn't care if they were Dracula at night. I wanted their firm's name into my company because I thought that would assure our success as a company. Of course, in subsequent rounds, in subsequent companies, this changed. So I actually either had a relationship with them already. Again, I was introduced as a trusted source. I asked for other entrepreneurs that they had worked with. I checked some of the blogs about what was being written about them. And then the third company, not only did I know, want to know them and their firms and so on and so forth, all that level of due diligence, but I also stayed away from firms who just had a bad buzz, okay? So I wouldn't even go to them, even though somebody said, so-and-so is really keen to meet you, but some other entrepreneurs had already told me that, they had a bad experience, or the firm had an experience of doing X. And so even if they had great cachet, I just felt, that since I was doing this out of choice now, that I could choose, and so why would I even waste my time with them? And so those that had a bad buzz or reputation, I wouldn't even bother to check their references. I just didn't want I didn't want to partner with them, really.
So I was just going to add one other simple thing. So I think this is also kind of an expansion of our discussion. There's always this question of how much money to take, which firm to take from, and another important data point. So when you're approaching a VC, let's say the fund is $100 million. So just to return the $100 million, if they made 5 investment decisions and all of them were sold for $100 million and they own 20% of the company, so that's pretty much what they're going to shoot for, right? Look at the fund size, and that's pretty much the minimum exit they're looking for, and still they have to get 5 of those just to return the fund. Needless to say, the 2 to 3x exit that they need to return to their LPs, right? So that kind of gives you kind of a spectrum of, okay, how much strings will the VC attach, or how much of my company they're going to want to have, because if it's a really large fund, then they're going to want to have 30-40% of your company, because if the outcome is big, they need an even bigger number, so they're going to want to own a bigger percentage. And the way I always like to work with my entrepreneurs and my founders is your job is to maximize the probabilities of a successful outcome, right? I don't know what that success is. That success could be $1 billion IPO, which is less and less likely these days, or it could be a 50 to 100 million exit to a really good company like Google, and I've seen a lot of those, even in the deepest recession. And what I always tell people is I cannot tell you what the right decision is, but what I can tell you is your job is to maximize the likely outcomes and choose between different outcomes, right? Never be cornered to only making one decision. That's the worst thing you can do. So your job is to basically optimize for that, and to do the homework for that is really simple. And like Bob said, that's one of the disadvantages of venture firms, and the reason why they're getting so active in seed investing is because the number of companies that have the kind of traction and scale they're looking for are a lot fewer, the number of exits are a lot fewer, and angel investors have kind of taken the early lead, what the venture capital firms once used to be. So they're feeling that if they're not playing in our space, they cannot be competitive in the Series Bs or Series Cs, so they're trying to be more aggressive in that space.
I'd like to reiterate something that Aydin said earlier. There's a wealth of information readily available, more so every day, about every investor, the prospective investor that you can meet or hope to meet. And you should be very diligent about researching actively before you meet people. While after you meet people, due diligence on them. Ask the prospective investor to introduce you to people that they've invested in before. With good experiences and bad experiences. Call them. Ask those entrepreneurs whether the relationship with that prospective investor was a positive one. The more diligence you do, you reduce dramatically the likelihood of any kind of negative result.
So I would just add one thing. I think that it's always, when times are good, the feedback you're going to get is always positive, so it's important to ask for those situations where things didn't really turn out the way that either party had hoped and how that was handled, because I think that that's going to give you a perspective on how the investor is going to treat you when things go sideways and things are not marching according to plan, because in a startup there's lots of landmines in front of you, and things are always going to be off course. It's how you course correct, and whether you do it at the same time and hand in hand, that makes a big difference.
Talk about the difference between the angels, the operational and professional people with money, where the terms are the same, where they're always like convertible notes were the same, or was there variation in?
The terms were the same for all 4 groups in our deal, which was not a convertible, but we just closed a Series A. But the terms were same for everyone we talked to in that group.
The The second question, which Aiden touched on, which is, what is generally, it seems like there is some kind of rule of thumb, like Bob mentioned, 12 to 18 months is when you look for to build a consumer product and before you want to raise this next round. Or a VC fund would look for, what is the typical amount that VC fund would look for into a company? Their investment, 20%, 30%, is there like also some kind of a rule of thumb around that?
Look, I mean, like I said, I think it's a moving target. You have to be very careful. I mean, we're trying to be helpful to you by giving some, milestones, but don't take this as a rule. So, a couple quick things. So, number one, I think between convertible and Series A, I think anything that's under $500,000 could be quickly closed and has the right incentives for investors. Convertible notes are great. They don't provide enough incentives for the sophisticated investors. So, the moment you're going above $750K to $1 million, I think a price round makes more sense. Even though, the voice inside of you is saying, yes, I would like to have a convertible note. Like I said, it's a balance. In general, most VC firms want to have at least 20% of a company. I don't think for angels that number is all over the place, but like make sure that they have enough stake so that they care about your company enough. And then what was the other question that we're talking about?
I think he was saying what percentage of the company do they really want to own, and I think that 20%, I agree.
20%.
Yeah.
That's sometimes also associated with the size of the fund or...
Like I said, just look at the size of the fund. The other question you asked is how much money to raise for, right? And then again, I'm talking mostly for consumer internet and mobile. If you're in consumer goods, if you're in retail, if you're in life sciences, these are completely different things. You might have to raise a lot more money if you're in semiconductor. I mean, I don't know if you have a factory or you're, just a chip design, whatever it is. But it used to be that 6 to 12 months was okay. After the 2009 recession, I think it's still true. There is not enough liquidity out there, even though the stock market has started to pick up. I would still say conservatively 18 months is what you should look for. And there is always, traditional rule of thumb is whatever you think you're going to do, it's probably going to take twice as long and you're going to need twice as much money. I don't know, strike a happy balance, right? Things are never going to go as expected. Have a cushion, don't run out of money, but don't raise too much money that is going to give you too much luxury or, too much relax. You have to be in some kind of a stressful and aggressive time schedule here. So you have to make sure that everything is lined up.
It almost seems that I'm in this position where the first money in is sort of this convertible note, friends and family, because quite frankly, you have PowerPoint and you're a new entrepreneur and that's the easiest way to get off the ground. And is that what you angels are seeing? You're going in after sort of that convertible note, friends and family, in with kind of a small Series A, or do you actually invest in first-time entrepreneurs with a PowerPoint?
Yeah, I'll respond to that one. Yes, I do invest in first-time entrepreneurs with a PowerPoint. A lot depends really on sort of a visceral feeling exiting a first meeting about the person's ability to succeed. And then, the point was made earlier that, the time period necessary to get to a decision depends in large part on a number of variables, but one really important one is what's the entrepreneur's track record. First-time entrepreneur typically takes a longer process time. But the fact that you're a first-time entrepreneur is not a limiting factor for me in terms of making a decision.
I think it also depends on how hot your area is, right? So I'm just going to use an example. I'm just talking to a founder right now, and I'm just going to say as I build more and more track record, I'm probably leaning more towards people that have some traction or some proof point. I mean, it could be just a demo slide, right? I'm not looking for crazy things unless something that is just a PowerPoint slide. But, if your area is difficult and it's going to be hard to convince people and it's not one of those hot areas, you have to do whatever it takes as an entrepreneur to get to the first milestone. That milestone could be shipping the product. That milestone could be having some revenue. Being able to say that is a very important thing. If it happens with family money, great. If it happens with friends money, great. If it happens with Series A, great. If it happens with convertible, it doesn't matter what that is. The most important thing is to get to that milestone and then improve your chances of getting the funding to get to the next milestone, whatever it's going to take to get that traction.
I'm going to move to this side.
My question is that there's so many VCs and angels out there. So is there any resources you recommend for startups to find out each individual's background and tracking record, VC or angel groups? And the second question I have is that there's so many questions we hear is that startup looking for funding. So I want to hear your point of view in an angel or a VC point of view to see what's your problem, what's your challenges you are facing.
So in order to see who are the VCs and what their track record is, there's a website, I think, called VentureSource. There's a few of them, but that's one that you can look at, and that lists all the VCs and their investments. I think the Funded may have something as well, some information on companies. And, well, this issue of Business Week that just came out is all about angels. In fact, Ron Conway's on the cover, and Iden's on that list, okay, as one of the top 20.
He's doing
okay?
autographs out.
I think he's number 13 in terms of his. So everything about angels.
Finally, I made it to a list, so I can say I'm in a list now.
So you can check that, and this, Google it. And it's, anyway, it's in this issue of Business Week this week. It's all about angels, so I was very excited to see that. So in terms of what problems you face, I mean, I'll turn that over to you guys.
Yeah, and I was going to ask, there are all these lists. I mean, trust me, it's the same thing. Just because I went to business school, I wasn't a different person. And just because I'm on a list, I'm not like some special angel or anything like that. So hopefully I can still keep helping entrepreneurs. There is also Forbes Midas list. Again, there are all these lists that it gives you some information, right? Just because you're in a Midas list, does that make you a great VC? I don't know, but it's some yardstick, and you just look at the investment decisions they made. Like I said, I think more important than the investor's name or a firm's name is the partner who you're going to work with, and your chances of creating the positive bias towards your idea. My biggest challenge as an investor is I'm an entrepreneur like yourself. I don't have anybody helping me. I don't have any admin. I'm always missing out on things. I can't follow up on every lead. And for instance, I don't have a very good rating on Funded. It's because I can't respond to every entrepreneur. A lot of times, I can't even explain why I can't get to someone because I don't have time. And that's probably my biggest challenge, because the only way I can be successful is optimizing which bets I make, because I have to make those bets count. And like I said, I'm getting 10 to 15 leads. There's no way I'm going to be able to get all of them every day. And that's my biggest challenge. But my hope is that by supporting the right entrepreneurs and creating success there, like one of the coolest things about being on that list, they actually listed how many jobs were created by the companies I backed and how much money was raised. So I'm like, wow, like not only was I lucky at Google, but I was able to back companies that created new businesses and created new jobs. So there's some satisfaction of seeing that. But anyway, Bob.
Yeah, my biggest challenge is just not having enough time in the day to meet with everybody who wants to meet with me. Like Iden, I don't have an admin or much infrastructure, and my record is spotty at best at making meetings and returning calls, just because the list of things that I have to do is a mile long every day, like an entrepreneur. So it's about optimizing and trying to direct my efforts to where they'll produce the best result. And a lot of times that means I don't do everything that everybody expects me to do.
Another resource I would add to that is just angelsoft.net. So I went to Sierra Angels, we're based in Lake Tahoe, and they're mostly made up of retired entrepreneurs from the Silicon Valley that are retired to Lake Tahoe. So we hang out and we use Angelsoft as a syndication software, and it's useful because it's a good way to get a quick view of deals. So I would recommend that as well.
So you can also get creative. So one of the best advice that I heard when I was starting angel investing as a VC, friend of mine told me that if you want to make sure that the product that you're investing is not bad, try doing a Google search with the product or company name and then sucks. Because, I mean, you'd be blown away. Just try this for anything. You'd be blown away how much information you can get by just doing this simple thing. Then create some iteration, right? I mean, Google my name and just say, oh, he's an awful guy, whatever. I mean, I have no idea what people are saying about me, and then you can meet me and kind of balance the two, right? Like maybe I'm like that, maybe I'm not, I don't know. But again, it doesn't really take rocket science to find out information about someone through LinkedIn, through their track record, through these lists and everything else. So.
Yeah, the only thing I was going to add is if you're an entrepreneur and you go to your board meeting and you say that you're not getting back to everyone because you don't have an assistant, the first thing your investors say, well, we go get an assistant. So maybe you guys should.
Thanks,
I sense an intern opportunity. Over here.
When's a good time to form an advisory board? And when you're in an early stage, when you don't have enough traction, how do you go about getting the interest of a potential value-added advisor?
One quick thing I want to highlight here, be very careful when you're doing the advisory board. The thing that you have to watch out is, I love your company. I don't want to risk the chance of investing my own money, but I can be advisor for a percentage of the company, or angel groups that charge you to present. I mean, those kind of things I think is like a ruckus. But on the other hand, an advisory board is really important in the sense that especially if you're a chip company or life sciences, and your risks are a lot higher and you have to overcome really high odds, an advisory board can be extremely helpful in convincing your investors that when you do hit those rough milestones and you need to execute on it, your advisors can help you open some of those doors. They could be people that can help you generate sales. They could be people that can call FDA. I don't know who they are, but be very, very clear that they have a clear value add and not just names to add on the advisory list. Because there will be people that are like, oh, I can't really invest, but I would love to be your advisor for 5% of your company. So, you have to make that decision.
I've the big challenge from an entrepreneur's perspective of an advisory board is actually making use of that advisory board. So I've many times had lots of people ready to be advisors and given them, some token amount of shares to keep their interest, and then never had time to really have an advisory board meeting or have one that's at all useful. And then they get busy, right? And then all of a sudden, 2 years are over, they earned their shares, and you never talked to them, and they never did anything for you. And the problem is with putting people on advisory boards is it's really difficult to get them off. Because then it's like insulting. Like, you never called me, you never had time for me, you didn't ask me for my advice, and now you want to throw me out. Like, you can actually ruin a great relationship if you don't handle it correctly. So over the years, I've experimented with the advisory board structure, and I think the best advisory boards are, for me, what worked was really small, like 2 or 3 people. So you have time to talk to them. And then I made it so it wasn't tied to a meeting. It was tied to sort of quarterly action items or quarterly meetings with me. So you would get shares, but they vest, they vest when you meet with me. So we have to have a meeting, and it was surprising how many advisory board members called me and said, hey, we haven't met this month. What do you need? So it was like 5,000 shares, but we have to have this meeting. So you really have to spend time in organizing that program and then making use of it. And when advisory boards don't work, it's because of us, the entrepreneurs. Because you can see the person, you can see that they're interested, you can figure out what's right to give them. So why isn't it working? Why is it a waste of your shares? Because you didn't have time to tap into them properly. So I would keep that in mind.
So 2 more things real quick. Don't have 2 founders and 10 advisors, right? I mean, you also want to build a team. If people don't want to work with you but still want to kind of have the option of benefiting from the company's success, that's another important thing. And and again, your advisors are not a substitute for your ability to execute. So don't just think that having 10 incredible advisor names is going to get you over the hurdle of like convincing the investors that you can deliver. But Anu actually is absolutely right that a small number, again, be very clear what specific value they're adding and make sure that the incentives are aligned. So like tie it to actual meetings or sometimes actual deliverables. Who cares about 2 years? It could be 2 hours. You make the call, you get me this deal, you get shares. It's as simple as that. So
The only thing I was going to add to that is what I've noticed, because we've had advisors at different stages of the company, that one of the mistakes we made when we started the company was we had a small number of shares. And so for an advisor, they might get 1,000 shares, which seemed like nothing. But later in the company's history, we did a split. People had more shares. And many times it seems like they have a larger number, even though the value is no different. And so when I look back, had we had more shares, I probably could have given up less of the company, which would have been more appropriate given the amount of value we gave. So I just always tell people it's better to have more shares in the beginning. Most people don't ask. So.
And there's some advisors that are good. Like, for example, if you're going to go into a sales cycle to an enterprise, or you're going to go into a sales cycle to a drug company or something like that, and you have, some big regulatory muckety muck or Colin Powell or somebody, then, it's great to have them on the website. Don't expect to ever talk to them, but it'll make your sales cycle a little bit easier, and maybe there'll be a couple of calls. So there's some cachet to having those names that help you with your specific vertical as well.
So I got a question over here.
So you mentioned earlier that as an investor, it's not a good idea to call every day to your entrepreneur, to your CEO. But what's the reasonable time that you should call? Not to another, to
I would love Bob to chime in here too, but I think the ideal scenario, and some CEOs and founders do this really well, like Todd, they give you quarterly updates. I think that's kind of the minimum amount of time you need to be able to show traction, even though some of my companies can iterate as fast as every 2 weeks. I think it has to be reasonable of time and just some update. I mean, I don't need to know everything that's happening in the business. I want to know you're not running out of money. Hopefully you're fighting for leadership. Hopefully you're executing, and the company is growing, both in terms of revenues, traction, or some other metric, and you're hiring the right people, right? It's not that complicated. I think the important thing here is not to mix, like if I have to call the entrepreneur to get information out, then I made the wrong decision, right? I think it's only the respectful thing to do, and it doesn't have to be formatted. Just send me a half-page email saying, here's the updates, and by the way, here are 2 things I need help with. Can any of you guys, and it could be just go to all the investors. So it's great, like now I know the company's doing okay, and I know 2 specific things that I can be of help. Why would I need to have to call you every week to find out how you're doing, number 1, and 2, to justify my existence as an investor or board member? You normally see that when people only make 2 investments a year and they have to justify, I only have 2 investments per year because I have to spend a lot of time with them. I'm like, it doesn't matter, are you making any difference for them or not?
From an entrepreneur's perspective, I think you want your investors to be investors, not managing your company. And so, I've dealt with both types. I've had investors who talk to you every day, which is very, very annoying. And the others that are not available enough, and you really need them, and you need their help. So it's really important to set up, the right level of communication. So basically, I don't like my investors to be surprised, and I know that in order to make full use of them, I have to ask. And so if I don't keep them up to date, how they're traveling around, they might see a business deal, they won't even recognize that it's a good deal for me because I forgot to tell them that I'm having these 3 incredible sales cycles and incredible results with some implementation that I just did, right? So you have to strike the right balance there.
One of the things that I do, a practical point, is early on after making an investment, I agree with the entrepreneur what the KPIs are for the business. And I encourage the entrepreneur to, every week, every couple of weeks, publish something. It can be as simple as a Google Doc or Google spreadsheet that outlines performance over the past, whatever the relevant time horizon is. It's an easy way for the entrepreneur to do it on his or her own time, for me to view it on my own time without interfering with the entrepreneur, and for issues to be identified and addressed, relatively promptly.
And I'm just going to add one other thing on Bob. The reason why I like consumer internet and mobile, this point is very important. How do you define success of a business? On the internet is very simple. Do you have users? Are they growing? Are you making money of them? And you can measure it very quickly. That's one of the reasons I like it, because I can actually see if it's working, and if it's not working, we can fix it. In a traditional business, say like I was in textiles, I have to order the textiles, it has to be manufactured, it has to come, it has to go to the store. By the time I know that I failed, it's been 6 months and it's too late to change the train. So again, for every business, there are different metrics and there are different criteria, but just wanted to add that.
And we have a question over here.
Under what situation should an entrepreneur pay to present to an angel group?
Never.
Yeah, never.
That's a quick discussion.
Never. It's never.
There?
Actually, that was one of my questions too. I was just invited to pitch launch our company, a demo 2010 coming up. And I was interested in Anu and Todd, if you ever did any of these, not necessarily paid to pitch. I actually declined because the $20,000 would have got me my iPhone app, so I decided not to do that. But when you're naive as an entrepreneur, you could get sucked into that very easily because you're invited. It sounds like it's a great opportunity, which it would have been a great opportunity. But I'm not going to pay the ticket. But did Anu and Todd go that route, doing like a bigger pitching, like maybe TechCrunch 50 or something like that?
Yeah,
and I'd like to ask Bob and if they actually go to any of these events. So I'm trying to look at effective time of, for entrepreneurs too, who are really busy running around doing everything, wearing every hat. Is this something as an effective approach to go ahead and do, to take this route? Or would it be better to sit face to face and try and get those meetings with potential investors?
I can chime in, on the have I ever done it. So as an entrepreneur, you'll be approached by a lot of these trade events, to pay to pitch. So it's like a participation fee, it's like a trade show, right? Or, it's a $16,000 production fee and you can be on all the, programs on American Airlines, okay? I've never done those. I've actually never pitched at any of those events. The minute I say there's a production fee, I'm like, okay, well, great. When you think I'm newsworthy, I'll do it. But I've actually been a judge and attended a demo. And I find great startups over there, right? So, it's really up to, if you have a targeted group of people that you want to meet, I don't think that these trade shows in particular aren't bad venues, because you do have certain number of angels and VCs walking around, and I love to attend them because I see good, great things, and it's a great way to find out what's new, and you definitely meet a lot of VCs and angels that are walking around trying to see what's new. So it just depends on if you want this huge exposure or you have a targeted list that you're going after anyway, and what the cash flow situation is.
Yeah, I was just going to add, my father's actually a member of the Keiretsu Forum, which is one of the angel groups that charges, and I personally didn't go and pay the fee and pitch to it, and I think that there's a lot of other options than paying to pitch to raise money, and I think that if it can be avoided, I would definitely recommend it. In terms of the big marketing conferences, I think there's a lot of success that's come out of TechCrunch 50 and similarly with Demo. For us, I've just seen so many companies pour a lot of capital into these events, conferences and things like that. I think like a marketing launch, like a one-time thing makes some sense. And for us, there's a specific set of conferences which are, there's 150 people that we sit in a room and give a half-an-hour presentation to who are the exact buyers that buy our products. So for us, that makes sense, but almost nothing else has. So I just ruthlessly manage that 20 grand, and you gotta be pretty damn sure it's money well spent to spend it, I think.
I think Todd and Anu are absolutely right. It has to be for a very specific reason. These days, the only events I go to, and I might pay a high price for, is to basically have 100 meetings all at once, right? So Todd said 50 investors. You can go to one of these events and feel like you can meet 40 of them, then it's a good investment, but don't go to these events. I don't think any of us would make an investment because a company was selected into one of these events and like one of the top 10 finalists, whatever. I mean, it's nice to have, but I don't think that solely justifies the decision. The biggest important thing for you is networking. I mean, networking for sales, networking to raise money. If any one of these events would facilitate it and has very high quality people, I have to underscore 3 times, high quality people, not just, people that you're gonna run into, that definitely you have to make that call, but then it's worth paying for.
I think we have time for 2 questions.
So as angels, how do you feel about the different ways companies getting equity into the hands of key employees before the angel round, right? So, options, warrants, stock grants, and so kind of what are your preferences? And also, how do you think about the pricing of those different options if they're, close in time to the angel round?
I'll take that one. I think in most cases, empirically, founders and employees on board prior to my investment are compensated by restricted stock purchases. So they actually purchase the stock with a buyback. A company buyback right, and it's subject to vesting and so on. One of the things that angels, more sophisticated angels or funds do is impose the same sort of controls on a company that a VC might. So try to work out the issues of founder vesting and so forth in a way that will make the company unobjectionable for a downstream investor. Pricing typically is a cent, as close to zero as possible at the very early stage, and there's not a whole lot of objection around that, I don't think.
I completely agree with Bob. A couple things. So mostly after the investment is a 409A process, and you have to do it with professional evaluators. It's important to have balance in terms of one founder having 80% and then everybody else having 0.01. I mean, you kind of want balance. You want key employees to be incented, and you want there to be sufficiently large option pool for new key employees. Again, it depends if you have 2 people, 10 people. Who do you need to hire to kind of round out the team, and that it's balanced and the people have the right incentives.
An important part of the pricing discussion in any priced round is the size of the pool. There are 3 elements to venture valuation. It's the valuation, the size of the pool, and the founder stake. And that's there are rules of thumb about how large a pool should be, but ultimately that's a negotiated item.
I know you said you guys, or all of you have a long list of things you have to do. What's the best way to get in contact with an angel, or like to pitch a company? Like, how do you get away from your busy days, like to pitch a proposal to a possible angel?
I have filters, natural filters that we've talked about before. Entrepreneurs that I've worked with, lawyers, because of my background, is a good filter for me. Virtually every startup company, many go to a lawyer before they look for capital. So I see a lot of deals referred in from lawyers. Other investors in my network with whom I've invested previously, Series A or institutional venture firms who see deals that they think aren't exactly ripe for an investment by them will send stuff down. So, but for me, if there's not a referral from a trusted source, the likelihood that I'll see it is diminished greatly.
Question here.
What's the size of the people angel investment?
For me, it depends on the sector that the company's in and the amount being raised, but generally it's 100 to 250,000 initial investment, and then reserve some to continue to participate.
And it's 25 to 150 for me, with most of the investment being somewhere in the middle. And coming back to the earlier question, how do you meet an investor? Be as creative as you can. If somebody is a big biker, instead of schedule a meeting, say, hey, can we go for a bike ride? Just be different, right? So if everybody is asking for a coffee meeting, you should be asking for the bike ride. If the person is a big golfer, hey, I happen to be a good golfer too. Can we talk? Just make the discussion as pleasurable as possible, and don't make it like, hey, I'm going to the dentist. Oh my God, this person is desperate to get the funds. They haven't done their homework. Just go through the checklist and make the meeting. Increase your likelihood of getting that meeting. Find the right connections. Think out of the box.
Yeah, I invited Aiden to coffee and it still worked. So.
Well, he invited me to coffee in my previous shop in San Francisco, where I buy all my magazines. So that definitely works.
So we're actually out of time. I'm going to allow one more quick question, hopefully. Yeah.
I wanted to know if you are currently working with a particular company that, let's just say, it's a software, let's just say, and another software company comes and it's similar, but not exactly the same, but definitely competitive. Would you even entertain speaking to them, or would it be something that you would just, not look at just because you already have an investment with a company that's similar?
So I think, look, these days it's happening more and more. I'm just been amazed at how many times I'll see a company, and within 3 weeks there are 7 other companies that are in the same space. To the extent that I can, I try not to invest in any one of them, because I feel that if there are 6, 7, one of them, they're going to all kill each other's business, outprice them, and hire each other's talent. In some cases, I can't help it. There is a situation where I invested in 3 companies. One of them was Todd's company, and they started in all different places, and within a year and a half ended up in the right place. I can't control that, and I'm also very upfront and tell the entrepreneurs, I can't sign an NDA. Only tell me whatever you need to tell me that's necessary for me to get a reasonable idea. Exercise good judgment. Obviously, if I do something that's really bad, I'm not going to be in business, so I'm never going to do that. But also, I can't really help hearing things, right? You'll see things that happen. It almost happens too quickly. Sometimes you hear it without even people intending to pitch you. issue. So unfortunately, it's the nature of our business, and things are moving really small. Like I said, exercise good judgment. And I try to be very upfront and transparent, and I say, look, I have these companies in my portfolio, or I've seen this and this. So I try to be upfront in terms of explaining my circumstances to people so they can make the best decision for themselves.
For guys like us who are semi-professional, whatever, have websites and so forth, it's a lot easier for you to do diligence and figure out whether, at least reduce the probability that there's going to be a conflict of interest. My policy is if somebody sends me, an executive summary that's clearly in conflict with a company that I've already invested in, I'll tell them. I'll say, take a look at this company. If you think that that's, my investment involvement in that company is a problem for you, then don't call me back. If you still want to meet, I'd be interested to meet. But you have to be aware that, even the most scrupulous, honorable people, are going to, information is going to get shared in some way, and that may or may not be productive for you.
There are VCs and angels that have this information on their website and others don't. And I've actually had experiences where a VC is looking at 2 emerging deals, including one was mine, and they've been incubating the competitor in their own office space, and they didn't tell us about it. And they actually asked us, like meeting after meeting, let's say 3 meetings. What are you finding out? Is this a valid space? Which customer did you talk to? And then there's a meeting when they said, could you lay out your product vision for the next 2 years on the board? And I actually got up to write it, and then something was creepy. So I said, let's not go there. I've got term sheets coming up, and I ended the meeting. So you'll meet all kinds of people, and it's up to you. What I've learned is that you just have to be very careful how much of your kimono you're willing to open, okay? Yeah.
So on that,
you just have to just say enough, but not everything, ever.
So on that note, I hope you'll join me in thanking our panelists.